Good afternoon, everyone. I would like to introduce our speakers. I'll go in alphabetical order. Here with us, we have Zach Allison. He's the founder and managing general partner and chief investment officer of Applied Real Intelligence. It's a venture debt opportunities fund. Hello, Zach. Welcome to the panel today.
Hi, Julia. Thanks for having me.
Then with us here, we have Charles Friedberg. He is the Chief Operating Officer of Libertas Funding. Hello, Charles.
Hello. Apologies that I couldn't be there today.
And we have Shant Sood. Okay, we have Shant right here. He is the co-founder and managing partner of Sanctum Altriarch Investment Management, and it is also a venture debt fund. So, hi, how are you?
Good to see you again.
Yeah, good to see you again. And what a timely panel with everything that's been going down. And I'm sure many of you have meetings today to discuss exactly what is going on. And I will ask you to introduce yourself and speak just a little bit to introduce your funds and your organizations. But I will ask you the most pressing question right after that, right? And the question is this a disaster or is this an opportunity? And how does what you offer play into capturing that opportunity? Okay, so please go ahead. Zach, we'll start with you. We'll go in alphabetical order.
Hi there. Yeah, so this is actually exciting times. Previously, I was actually, in my former life, I was a loan underwriter of media and telecom loans during the GFC at Scotiabank in New York. So everything that's happening now will be different, of course, this time around, but there's a lot of similarities. So it's everything that's kind of playing out it kind of makes me feel right at home again. So I went from underwriting loans at Scotia to trading bank debt, actually, and CDS at Deutsche Bank, starting in 2012. I'm back when we were the #1 fixed income shop and biggest bank in the world. So I got a lot of experience with what we're seeing now as well. And so it's funny, I had about 250,000 views of my LinkedIn post yesterday and 8 different media interviews, because I think I'm the only venture lender in the world that actually has traded bank debt and underwritten it. And I've been at 3 trillion-dollar firms: Scotiabank, Deutsche Bank, and then Sun Life, where I helped to manage a $25 billion fixed income portfolio. So long story short, that's where I kind of learned the trade. And so this is kind of sad to say, but I actually like what's going on right now because it makes me feel at home. This is where I can add real value. I mean, this is where a lot of people are panicked and have no idea what to do, and I'm able to handle this. And so it's like being home again. So that said, I started a venture debt fund, started building it out about 4 years ago. I just saw a huge opportunity in the space. It's the safest way to fund innovation. And a lot of people think about it the wrong way. They think there's equity risk and debt returns, but it's actually the complete opposite. And what we've seen in the space with the non-bank lenders historically is returns that are 15 to 20% with very high consistency, very low volatility. There's never been a year in the history of venture debt where it's lost money across the board, including 2009. And I've looked at SVB's books all the way back to 2005, along with other venture lenders like Hercules. And we'll talk more about it today, but suffice it to say, this was a phenomenal asset class or product in terms of risk-adjusted returns, because not only was the drawdown risk very low and the volatility very low, but it also has very low correlation to the broader markets. It's a very low beta product.
Zach, you're stealing my next question.
Yeah,
sorry. Okay.
So suffice it to say, so Julie, I'll leave it at that, but I will say that right now, and this is the key point, this is the fattest pitch we've ever seen in venture debt, probably in the history of the product. This is Right now, we've got a similar opportunity to what private lenders had in 2009 through 2012, when a lot of people got out of the market at the wrong time, and you had absolutely historic returns at shops like Blackstone and Apollo and Ares. I think our upside is even greater. You basically just taken 80% of the market offline, because it's not just SVB, it's other regional banks as well. So the lending market's completely shut. The equity market's already closed. There's no exit for these folks. It's unbelievable. Yeah, I'm seeing deals that are 60% IRR with first lien with an LTV of 10% right now, just to be clear. So anyway, I'll pass it to the rest, but this is a historic opportunity.
Charles, let's go to you with an
Sure.
introduction, kind of what your thoughts are.
Sure. Charles Friedberg. I'm the Chief Operating Officer of Libertas. We offer loans and advances to small and medium-sized businesses. We've originated about $2 billion since the firm's inception in 2016, and we did about $700 million last year. We'll do about $1 billion this year. The reason I can't participate today is because, as a lot of folks can imagine, we're getting inundated with phone calls from small and medium-sized businesses who are looking for working capital lines and whatnot, and so we're quite busy today. We don't actually have a fund. We allow institutional investors to participate alongside our balance sheet capital. They simply participate alongside us. And we offer venture debt-like returns, although with significantly shorter durations, on an average weighted duration basis of less than a year. Prior to this, I was at Angelo Gordon, and then I was the co-founder of an emerging market distressed debt firm. So I spent a lot of my prior 28 years in private credit and distressed credit.
Thank you. Shant, go ahead.
Hi, Julia. I'm Shant Sood. I'm a managing partner and co-founder at Sanctum Altriarch. Investment management. Sanctum Altriarch is an alternative investment firm that makes primarily debt investments into mid to late stage technology companies. Unlike venture equity, my fund, which is squarely in the mid stage of venture debt, and we can talk about that in a minute. This part of venture lending is vastly underserved, and we believe there remains significant opportunity for high risk-adjusted returns, especially in today's markets and with the recent developments with SVB. My co-founder and I have been successfully investing into technology companies over the past 20 years. That covers a bunch of different cycles, starting with the dot-com crash, and so there's a ton of amazing learnings that come out of that point in time, which is the lowest point in venture debt. Our investments are typically structured as senior secured term loans with a target yield between 11 and 15%, plus warrants and equity upside. And that's all of that is without any leverage yet. There's ample co-investment opportunities for our LPs. To your specific questions, Julia, this is a very interesting time for us. As Zach mentioned, I think if you just go back a month, even before any of the SVB whispers, so to speak, our sector was massively underserved, massively undermarketed. The various macro events, such as the rise in the interest rates, the volatility in the tech markets, those are providing sufficient deal flow, more than what we could possibly handle. But then on top of that, if you take SVB out of the equation, it's sort of the bursting of the dam, so to speak, in terms of the amount of deal flow coming our way. And I'm happy to dive into more detail as the panel progresses.
Thank you. So let's address obviously what's on everyone's mind today is the Silicon Valley Bank, and what is the impact on your products? How big is the opportunity? Are your phones ringing off the hook? Like, what is going on there? What are you hearing about SVB? Are people scrambling? Or like, what, give us some color. What are you hearing? And Zach, we can come to you and just.
Sure. So yeah, it's definitely created panic within the venture ecosystem and the startup ecosystem. As investors, a good investor thrives during periods of volatility and dislocation. One thing I think is important, though, is to look for folks that have clean balance sheets, because most of these existing loans are very high quality, but because of the funding dislocation, some high quality startups may have some some unforeseen hiccups or worse that they didn't really think about as a real possibility, ever occurring. So long story short, it's a great time to be a lender in the space or a capital provider of any sort, really, if you've got a clean balance sheet and you don't have to spend a lot of your time triaging your existing portfolio. So, to be honest, it's just very fortuitous for us. We just 2 weeks ago, we launched another fund for qualified clients, which are people worth more than 2.2 million. Previously, you had to be a qualified purchaser with a net worth of more than 5 million, but we were getting so much demand, and this was all, clearly pre-SVB. This, we were getting so much demand from the retail segment. When I say retail, I'm talking about RIAs that have what I call like mass affluent clients between 2 and 10 million in assets. There was a lot of demand coming from that segment because they couldn't find returns in anything else. A lot of these folks historically have been in a 60-40 portfolio or something close to it, where it's mostly stocks and bonds, and it's kind of traditional, long-term investing, but they haven't really been in alts, and that's really started to change over the last 2 years or so. And that's one of the big themes in the industry generally, is there's this massive amount of capital in the mass affluent segment that was never involved in alternatives. And now they want in because they see that there's really excellent returns in private credit and potentially private equity, venture capital, real estate, of course, infrastructure, and other more esoteric asset classes. So anyway, long story short, for us, it's perfect because we just launched this new fund and we're already getting a lot of traction. And this just takes it to a global scale because most people haven't heard of venture debt, or they have massive misconceptions. Like on the last panel, somebody was saying that, you've got binary risk in debt and they'd rather own equity, which is like completely false, because you've got binary risk in equity. It's either going to zero as a startup or it's going to do really well, right? On the other side of that, it's debt, where you've got steady 15 to 18% cash coupons every year that are floating rate, paid monthly. So you've got no duration. You've got zero interest rate risk. In fact, you make more money when rates go up. And you've also got 10-year warrants on the majority of deals. So you're hedged against inflation. One of the best inflation hedges is call options that are long dated. Prices go up, the value of those calls go up, with the value of equity. So really, I think this is just a historic opportunity. And the key takeaway is this: there's a lot more demand for capital right now than there is supply. And that's all you have to know. And so it's a target-rich environment. If you've got capital and you know how to deploy it and you know how to manage risk, this is the perfect opportunity.
Great. Charles, go ahead. Your thoughts.
Yeah, sure. So, this is a good time for Libertas to be in business, but this is really for us just a continuation of the events that we've seen over the last 12 months as more traditional borrowers, and I would even say some of the, the venture debt players have tightened. We have seen an increase not only in the credit quality of our books, but in the opportunity set as, more people look, towards other financial, finance providers other than banks or venture debt. In our case, we have very similar rates that we offer to venture debt, but with no warrants, so there's no dilution. So for us, this has been a very good time. Over the weekend, we were inundated with calls from obviously companies that had their credit lines or working capital lines frozen. I think that's one of the areas that has not been discussed. A lot of these companies, chose SVB, those lines are performing, and yet all of a sudden they're waking up on Monday morning and they don't have an operating line or a working capital line, which is where we can step up. And I think that's the area, quite frankly, that the government has really missed out on. And that's the part where people argue Main Street versus Wall Street. This is an example of where a quote bailout really has hurt Main Street, because these small businesses live on these, operating lines, and that's where Libertas comes in. So for us, generally speaking, that's trying to answer your questions generally, but for us, it's a very good opportunity. I do think the government has misstepped a little bit. That is clearly going to benefit folks like us. But it's an unfortunate situation, but we're in a good position to be able to provide capital and help small businesses as well as our partners with it.
Great. Thank you. Shant, go ahead.
When it comes to, thank you, Julia. When it comes to venture debt, I think it's useful to step back and understand what is venture debt and how Silicon Valley Bank necessarily plays in there. And I think the simplest rubric is to think of venture lending as two different silos. One is bank lending, and the other is non-bank lending. So at the very simplest level. So if you think about the bank lending bucket, the largest player is Silicon Valley Bank, but you've got a couple of other regional commercial banks such as Bridge, Square One, Comerica, etc. On the non-bank side, you've got private credit funds, you've got BDCs. These guys are structured in a totally different way, and their returns are very different. So the non-bank group will have yields that are twice what the bank group does, will provide more capital, and it's probably closer in the spectrum towards, in terms of analysis and diligence, to venture equity than the bank group. So on the bank group side, with the exit of Silicon Valley Bank, and this is still an unfolding story, so we'll have to see what impact and who takes over and what happens to the infrastructure on a day-to-day basis. But if you have the exit of the largest market share player out of the bank group, you're going to see a number of other banks trying to fill that slot. But then you're also going to see a lot of that business transition over to the non-bank group. Mm-hmm. So the non-bank group, which is where Sanctum Altriarch is, along with a couple of other BDCs and some other prominent names, those guys are not set up to do subscription line financing or letters of credit or revolvers. That is very much a bank product. But what the venture debt non-bank group does very well is to actually do the diligence and provide a more flexible, a larger amount of capital to high-performing technology companies. So the displacement by SVB will cause opportunities for a lot of other banks for the bank products, but it'll also cause a lot of opportunities for the non-bank guys like myself. And so we are currently in our first fund, and we are completely inundated with deal flow, as I mentioned. It's no surprise, because even before the SVB issues, this was a massively underserved market with a supply-demand imbalance. So my co-founder and I, we've roughly sketched out about 6,000 companies that could be a potential fit for our fund and our strategy, and that's before SVB. Now, we are never going to touch 6,000. That's just a very high top-of-funnel number. But it just gives you a sense that in the venture debt community, there's roughly about 10 funds, that's it, in the non-bank fund category, that have consistently showed up and have grown assets that are servicing and financing technology companies. So as we currently sit here today and we're watching the SVB debacle play out, I guarantee that a lot of the very large private credit funds that are on the non-bank space are looking very carefully at this supply-demand imbalance and trying to figure out a way to get into this space. Mm-hmm. Luckily for the venture debt players, this is a very high barrier to entry type of space. My co-founder and I have been doing this for a long time, and it's really useful to have gone through cycles to understand what a bad venture debt loan looks like. And guaranteed, in the flood of deals coming to us, we're going to see a lot of stuff that we just want to pass on. But it's a great time to be a lender. We can dictate rates, terms, warrants, and we can essentially cherry pick the best assets that we like to lend to.
So effectively, are you saying that the impact of SVB being gone is going to be quickly kind of, other firms will move into that space, other banks will move into the space, other private lenders will move into the space, and so the market will kind of close that gap? Or is this going to be a monumental issue for the Silicon?
I've got a couple of thoughts on this, and everything that Shant said is spot on, 100%. You're probably thinking about things very similarly. One of the things I think is interesting is I've seen a lot of founders saying, "Hey, take your money out of First Republic, or obviously they took it out of SVB, and move it to these kind of neo banks like Brex or Mercury," which I think is terrible advice. Why would you take your money out of a systemically important bank and go to a neo bank that's never managed risk through anything but the biggest bull market of all time? I mean, it's just terrible advice. So to your question, Julia.
Well, they're talking their book.
Well,
I mean, they're invested in all those companies, so it,
Oh yeah,
you
no,
know.
of course, yeah. It's just funny. Yeah, to Charles's
Yeah.
point. Yeah, they're just you got to know the source of your information and what their angle is. Like
I mean, it's
when
no
asked-
different than the VCs who told all their people to take
Yeah.
money out of SVB, and then a day later said that they all signed an agreement saying that they go back to SVB. I mean,
Yep,
you have to take a lot of what's coming out of that area with a grain of salt.
100%. I mean, those are great points. But just to answer your question, Julia, this is not something where you can easily fill the gap. I mean, the reason this part of the market's so attractive fundamentally is because it really is a niche with high barriers to entry where you need to have, a specialized skill set, because all these companies are EBITDA negative, right? And so banks cannot really get comfortable with that. SVB did, and that's why they had, huge market share. Some of the other banks that also were in the space on the margin also are in a lot of trouble right now. Like Signature Bank, for instance, was getting into the venture lending space. They're out of business now, and many of the others that have been trying to kind of move in on the commercial banking side are all under significant pressure. So it's not just SVB; it's really all the banks. I shouldn't say all the banks. The majority of banks are taking a step back right now. And the ones that are trying to raise their hand to take over that business are these neobanks that kind of see it as a really great opportunity. But I would warn them about adverse selection, because who's going to run to a bank if they need to fund payroll the next day? It's somebody that isn't that well capitalized. So it's kind of like catching a falling knife. Like, do you really want the worst clients of SVB that are like the most desperate and needy? Not really. And what Breck said, which I thought was interesting, and they were trying to raise a bunch of money over the weekend, was we're not going to make money off this. We just want to do it for the relationships. Here's the thing: relationships don't matter like they used to, right? In the sense that people are out for their own survival. Like SVB just disappeared. Those relationships are worth very little right now. So if you're gonna basically be a neobank and step up and take a lot of poor risk-adjusted bets in an attempt to win the love of founders, it's not going to help. They're going to leave as soon as that bank, as soon as those banks crumble. Also, they're going to be gone in 2 seconds, right to JP Morgan.
And
Yeah,
if you're not a systematically important institution, right? If you're not right, yeah.
I think so. I don't necessarily disagree with anything that was said, but I think in answering the question, I don't see. So it depends on which segment of SVB's business you're talking about. If you're talking about lending to startups, and those types of businesses, I don't necessarily see another, large institution entering that space immediately or very quickly. So I do think there's going to be a gap in funding for tech startups, venture, and things of that nature, at least for the foreseeable short term. For the other areas of its business, warehouse lines, things like that, that gap is already being filled, I can say with certainty. Over the, that is happening. But I do think that for small founders and whatnot, other than some of these neobanks, which again, I don't think they're gonna, not only do they not have the balance sheets to step in and do this, but I don't even think they necessarily have the operations to step in and do this. There will be, in my view, a gap for funding for those types of businesses in the near term.
SVB has been in business for 40 years. It is the preeminent name here, and it is multiples times larger than the next bank. So whether you're talking about, and I agree with you, Charles, I think that other banks will step in if they haven't already for the banking functions.
Yeah.
But for the non-banking functions, the loan book, which I'm going to pencil out roughly 20 billion of venture debt, and I could be off by a bit. That is a massive book for anybody to absorb, let alone understand in one shot. So that has to fall into the hands of either a group of very sophisticated underwriters who understand this stuff. But it probably won't land in one place. The one thing that I think.
And by the way, Shant, the only thing I'll add to that is that, and we don't know this for certain, but obviously the auction failed over the weekend, and I would bet that venture book had something to do with it. I have no inside ball on that whatsoever, but all the other stuff, if you look at SVB's balance sheet, it was a very good balance sheet.
Right.
They had a lot of very traditional bank stuff, but they had this other pocket beyond the AFS book that I think a lot of other banks would just be hesitant to underwrite.
Yeah, it is not a typical bank that can be easily acquired. There's a lot of other interesting things going on there. About 20 years ago, during the dot-com days, I was part of a liquidation of a major venture debt fund called Comdisco Ventures, and Similarly, when buyers came through the door to buy that portfolio, it was not one buyer, it was multiple people trying to understand different parts of the business. The one quick thing I'll quickly mention is SVB has been around for such a long time. It actually has incredible infrastructure in the Valley and beyond within tech. So whoever ends up buying SVB, at least for the infrastructure, the talent, the systems, the database, that is quite valuable. And hopefully whoever ends up inheriting that or acquiring that will be able to fill some of the gap that's been left.
What are the returns like? So let's talk about the returns and let's talk about risk, right? So in terms of what you're doing, how does venture debt in terms of returns compare to equity? Because as we know, private equity, I mean, no secret, has been overvalued. And so what do you expect that dynamic to be like? So let's look at the returns first, and then let's look at the risk side of the equation.
Well, I mean, we don't, yeah, Zach, you can go ahead. I mean, we're not a venture debt shop. So, but I guess I would imagine right now it's pretty attractive on both sides. I mean, debt is ahead of equity. So from a risk perspective, you're ahead in the cap stack. Right. And if you're getting, better returns at this point in time, it should do better than, I think it should do better than private equity over the near term. But
so just I want to just kind of frame out how it's done historically first, and Shant was kind of talking about this as well. But think of venture debt as debt that's provided to the winners of the venture equity lottery, so to speak. So you've got all these folks that go out and raise money at angel stage and seed stage and Series A, and a lot of them go out of business, the majority, and we all agree on that. However, that 10 or 20% that does really well and keeps growing reaches a stage where they're now generating revenue, and typically, and most venture lending begins Series B and beyond. So for us, everybody's different, but we're looking at companies that have a minimum revenue of 10 million per year, oftentimes multiples of that. So you're basically betting on winners that have typically just raised an equity round, and you're coming in to help extend their runway, give them additional growth capital, but do it in a way that's cheaper and a lot less dilutive than equity financing. So that's where it kind of like fits in. So you're typically the only debt in the capital structure. You're senior secured. You've got a lien on all the assets of the company, including intellectual property and cash, which is not insignificant. All right, and you're typically earning on average about 15% debt yield. And we know this because we're in the market, but you can look it up yourself by looking at the public filings of the business development companies that are publicly traded that specialize in venture debt. So the biggest of these is called Hercules, and they've been public since 2005. And what's nice about these filings is, as a BDC, they're required by the SEC to report all of their loan positions. So we can go back to 2005 and see the pricing on every single loan that Hercules has ever done. And they're the second biggest venture lender in the entire market behind Silicon Valley Bank, and they're the biggest non-bank lender. So long story short, we know with certainty from SEC filings, looking at 5,000 plus deals going back to 2005, that the returns on the debt side have been about 15% per year with very low volatility. Okay. Mm-hmm. We also know there's never been a year when venture lenders have lost money, because we can look at SVB's loss rates and loan charge-offs. We can also look at the loan charge-offs and losses of the BDCs. Now, I'll tell you a fact that I think it is worth noting. In 2009, the worst year in the history of the markets in our lifetime, at least, SVB had loan charge-offs of 2.6%. So that means 97.4% of their book was performing, and they still made money. So they were in the green with their venture loan portfolio in 2009, when the majority of banks were in a lot of trouble, and many of the largest banks went out of business. So that kind of gives you a sense for how stable this product is in terms of its low risk. Now, in addition to the loan, you also get equity warrants on the majority of deals. SVB and other bank lenders take warrants. The non-bank lenders typically take warrants and take more warrants. And I think, quite frankly, are a bit more sophisticated, because some warrants are going to be worth more and some are going to be worth less. And that depends on the upside of the company. Banks are a bit naive in their approach in that they kind of take the same warrant cut on every deal, whereas sophisticated non-bank lenders will kind of size their warrant position accordingly, right? And that's a big difference between what we do and what I think traditional venture lenders do. Like, I'm a capital markets person. I've worked at $3 trillion firms, and like, this is what I do is I price risk. And so those equity warrants on average have been worth anywhere from, call it 3 to 5% annualized, depending on the companies and luck to some degree. But on average, you're getting about a 20% return in the non-bank market, 15 to 20. And to Shant's point, in the bank market, loans are priced at a much lower level because they're not making loans to generate economic return. They're making loans to bring the business in so that they can make money on all the ancillary business, the cash management. They want your deposits. If you want a loan from SVB, or if you wanted one, you would have to keep all your money with them, and they would basically own the entire relationship. So they were giving you a little capital in terms of a revolving credit facility or some lines of credit. What the customer was giving SVB was basically free capital the last 13 years, because SVB wasn't paying any interest on the deposits. So that's where we were historically, just to set the stage. And in terms of where we are now, even before SVB collapsed, the pricing had gone up because these are floating rate loans, and they're typically marked to prime rate or SOFR plus a spread. So as prime rates increased from 3% to close to 8%, the loans have gone up in pricing. Also, big factor here, the equity market has been very hard to access for founders over the last, call it 15 months or so, 2022 to now, because valuations have come down a lot. So capital is prohibitively expensive. VCs have dry powder, but they're not deploying it. The exit market is closed. Nobody's been able to IPO. So you got low valuation, high cost of capital, smaller deal sizes, fights over valuation, and it's taking a lot longer to get deals done. So all that has meant that debt has become much more prominent for founders over the last year to year and a half. And now you add in SVB failing and other banks like Signature Bank and some of the other regional banks struggling or failed in Signature Bank's case, and the pricing will jump. Like, there will be a repricing of risk, and it will be significant. The last thing I'll add here is that there is a bit of a cap in terms of how much you can charge on the cash side, because when the cash pay is too high, it does put the companies at a bit of risk, right? So you kind of have to limit what you can charge them in terms of cash pay. I don't see that really ever going above high teens, but you can take big chunks of equity now at very attractive valuations, and you can be the price maker, not the price taker. And so that's where we're seeing the huge IRR bumps. We're seeing these equity packages that are incredibly attractive, that's bringing IRR on some of these deals that are very low risk to 40 or 50% IRR. And I've looked at 2 unicorns in the last couple of weeks alone before SVB, that $1 billion companies. I don't think they're worth that much, but they're still, they're very reputable, well-known unicorns. And both of these deals were mid 40% in terms of IRR. And about,
Thank you.
Yeah.
Thank you. Let's go to Shant and then to Charles.
Thanks, Julia. I think our question was about the return profile. Zach covered a bunch of it, but essentially we make our returns from 2 different buckets. The first is the credit bucket, which is essentially senior secured term loans, blanket liens on all assets that generally have an 8 to 10% current cash yield. So we distribute cash quarterly, plus another 2 to 4% that's comprised of accrued interest and PIK. So if you just look at the gross unlevered, just on the debt piece, which has very low volatility and very, very low loss rates, you're in the 12 to 15% range. And that's before putting any kind of leverage on our fund, which is also very typical. So that's just the core contractual debt yield. The other source of our revenue is the equity side. And because we're lending to companies that are Series B or later, high growth businesses that have very strong gross margins, but happen to be negative EBITDA because of their growth, we are able to pinpoint various companies that are not only good credit underwriting, but also have upside optionality. So the warrants that we usually price are usually in the money from the get-go, and they generally add another 300 plus basis points on an annualized basis to the yield. So the debt part is 12 to 14, add another 300-ish basis points from the warrants. Obviously, that's not contractual, but we do get the warrants and they do perform most of the time. And then on top of that, we also have the ability to make direct equity investments through our fund. So if you can imagine, if you're a lender first into these companies, you know everything about the company, even more than the venture equity investor in the next round. So we have an information arbitrage and asymmetry that we bring to the table. And those equity investments are usually smaller equity checks that go into our existing portfolio, have performed very well. All of this triangulates to a roughly 15 to 20-ish% all in IRR. But the best part is that the credit yield of this is actually very, very strong. And that comprises about 75% of the return. So that's around 15-ish%.
Thank you. Charles, go ahead.
Yeah, and while we're not venture debt per se, right, we're providing advances, and rather than interest in principal, we're a factoring company. You know, participants that participate alongside our balance sheet are achieving about a 19% IRR, but again, with an average weighted duration of less than a year. And because these are fully amortizing advances, they're getting paid back principal, you know, within 7 to 8 months. And what you guys would term the interest, what we would call is, you know, the advanced factor amount, you know, that's over the remaining couple of months of the life of the term. And in addition, we provide a 2% first loss protection for every monthly vintage to participants and cover the first 2% of losses, which have been historically kind of the default rate for what we've observed at our firm. So, you know, it's interesting. We are definitely a competitive product to venture debt, not only in terms of attracting capital, but also in terms of companies. We tend to move a lot more quickly. You know, we can fund companies in a day to 7 days. And again, unlike I think the quarterly payments that, you know, typically venture debt gets, we get remittances back from companies on a daily or weekly basis, as do our participants. So the capital cycle, the cash cycle is much quicker for what we do and for our participants, but the returns are, you know, like I said, in you know, kind of 19-ish%, not including the 2% first loss protection.
Thank you.
Julie, can I just jump in here? So Charles, is almost like a first loss capital. You know, you're protected against 2% downside.
That's right. So every vintage that a participant participates in, Libertas sets aside escrows 2% of remittances, such that in the 13th month, if that vintage experiences any losses, Libertas will top that up on the first 2%.
And you aren't a fund, right? People co-invest with you.
Yeah, not even. We don't do it as a fund. I wrote this in the chat. Participants have their own account. We simply ACH or wire money into, you know, a DACA account, and then send that out to the merchant or the client. And then when the remittances come back, it automatically goes right back into their account. So they're not commingling their assets with anyone else. It's their capital.
So it's almost the equivalent of like a separately managed account.
It is. It's really a separately managed account. And as part of that agreement, they also provide us with their credit guidelines. So if they're different from us for some reason, they want to eliminate an industry or a state or whatever reasons, we take that into account.
Yeah, that's great. And I have a question for the venture debt guys. So is it smarter just to? I'm just talking about the situation you guys are in right now. Is it smarter just to focus on the best deals? Because I mean, the best deals are going to be phenomenal. Or is it smarter to grow really fast, you know, and just take every deal that Silicon Valley Bank is dropping because it's 50% of the market? Thoughts?
Marty, in our case, I'm very focused on protecting downside and limiting downside risk. So the way I'm thinking about it is, to Shant's point, there's thousands of deals out there. There's about 3,000 to 3,500 deals that get done every year. We need to do about 10, right? And now there's going to be nobody else in the market to do those 3,000 deals. So we're going to get 10 times the amount of inbound that we got previously. As I think the key to success in this market is to be extremely discerning, just very focused on the downside risk, because the upside will take care of itself. In this market, it's all about just only swinging at the best pitches. I mean, I anticipate we'll probably underwrite less than 1% of the deals that we take a look at.
I think that's
Shant?
right. Yeah, I think that's right. I think we're certainly seeing a plethora of deals. It's up to us to now make sure that we're going to see every kind of deal now, thanks to displacement by SVB, and we just need to be super diligent on our returns and our analysis. I think the historical backdrop of the returns and the downside protection will continue on. There's not going to be any change to the performance of this asset class by the top performers.
I think we're out of time unless there's any questions from the audience. Any questions?
Quick question for Charles.
Yeah.
Hey, Charles, I want to clarify. You guys have your own money invested or put up alongside your co-investors, and then you have a 2% first loss?
Yeah, so the way that we fund partners is through our own balance sheet capital and then participation, syndication. So to get syndicators comfortable with what we're doing, we provide a 2% first loss protection because we're doing all the underwriting. We're doing all the underwriting, the servicing, the origination. So that's why we provide that 2% first loss protection on a monthly vintage basis.
And that's 2% of the capital, not net of the interest earned.
No, it's 2% of what's known as the right to receive. It's the full amount, not of the principal.
Right.
What you would call P&I, what we would call the full factor amount.
Okay.
Yeah, that's right. A little bit better deal than just principal.
Yeah, agreed.
Any other questions? Well, so that's so. I just want to kind of like bring this home. In 2008 to 2010, it was really like the golden age of like secondaries, and then like private debt just exploded beyond belief. And I've been thinking there's a great opportunity in private debt that the banks ultimately have to pull back, right? Mm-hmm. And then this thing just happened this weekend, which I think is much bigger, and there's going to be opportunities in debt that are going to be much superior. So kudos to you guys and good luck. All right, thanks so much.
Thank you.
Thank you so much.